You know that feeling when you look at your portfolio and it just feels like the whole stock market is some kind of rigged casino? Or maybe you've watched your hard-earned savings just shrink during a downturn, all while traditional financial advisors casually tell you to just hold on for the long run? I mean, it's really no wonder that 90% of retail investors fail to beat the market. Well, if that sounds familiar, you are in the exact right place. Welcome to This Explainer. Today, we're diving deep into one of the most practical, no-nonsense guides ever written for traders and investors. We're talking about Fred McAllen's book, Charting and Technical Analysis. Now, McAllen spent decades as a financial advisor and portfolio manager, and he wrote this book with one extremely clear mission: to pull back the curtain on how Wall Street actually operates, to expose the traps set for average retail investors, and to teach you how to uncover the raw, unvarnished truth that is hiding right there in plain sight on a price chart. So let's get right into it. Here's our roadmap for today. We'll start by deconstructing the Wall Street illusion, then map out Dow Theory, and build up your toolkit with candlesticks, support and resistance, patterns, and volume. And finally, we'll cover the absolute glue that holds all of this together: risk management and psychology. Section 1. The Wall Street Illusion, Unlearning Bad Habits. Because to master the market, we first have to unlearn some dangerous routines. Most beginner investors do the exact same thing, right? They check the headlines, they buy a stock on quote-unquote good earnings, and then sit there in total bewilderment as the price plummets minutes later. Why does that happen? Well, it's because fundamental analysis is basically lagging bait. By the time that flashy headline drops, the institutional players processed it weeks ago. They bought low, and now they're selling to FOMO-driven retail buyers. Technical analysis, on the other hand, doesn't try to predict the future. Instead, it measures the real-time footprints of this smart money, so you know exactly who actually holds the power. And that brings us to a really harsh truth from McAllen's years inside the industry. He says nobody will ever care about your financial survival more than you do. Millions of people blindly trust financial advisors, but the reality is many of them are just salespeople. They're trained to collect fees while chanting buy and hold. But holding through a 50% crash? That isn't a strategy, that is just emotional torture. Learning to read charts is your personal insurance policy. It empowers you to step aside before the damage is done. Section 2. Dow Theory and Market Trends. Macro Market Waves. Now that we understand exactly why we need to look at the charts, we need to ground our analysis in the big macro cycles. Charles Dow provided the absolute backbone of technical analysis, pointing out that markets move in 3 broad phases. It all starts with the accumulation phase, at the very bottom of a painful bear market. This is where smart money quietly buys up bargains. Next comes the public participation phase. This is usually the longest, most profitable upward trend where mainstream confidence finally returns. And finally, the dangerous distribution phase. At this point, the media is absolutely euphoric. The public floods in greedily, and smart money, they quietly dump their inventory right before the next crash. Section 3. Candlesticks, Support, and Resistance, the Visual Language. Let's actually define the battlegrounds where these buyers and sellers clash. Fred McAllen heavily favors candlestick charts, and for good reason. They were developed way back in the 1700s by a legendary Japanese rice trader who reportedly made the equivalent of $10 billion. Yeah, billion with a B. Candlesticks offer maximum visual impact. You have this wide middle box called the real body, which shows the exact distance between the opening and closing prices. A green or white hollow body means buyers dominated. A red or solid black body means sellers took control. But you really want to pay attention to those thin lines extending up and down, the wicks or shadows. These show the extreme highs and lows of the session, literally pointing out exactly where price was forcefully rejected. So where do these epic battles usually take place? At support and resistance. Listen, if you take away just one single thing from this explainer today, let it be this. Support and resistance are not magic, arbitrary lines drawn on a screen. Not at all. They are highly responsive areas of supply and demand memory. Support is essentially a price floor where buying demand is strong enough to halt a decline. Resistance is an overhead price ceiling where selling supply absorbs all that incoming buying demand, completely stopping in advance. But what happens when these levels actually break? You get something called role reversal. When a massive resistance ceiling shatters, it magically transforms into a new support floor. Why? One phrase: trapped psychology. Just think about all those short sellers holding on to painful losses. When the price pulls back, they eagerly buy just to break even. And sideline buyers? They jump in too. Boom, you get instant buying support at the exact site of former resistance. Section 4. Chart Patterns and Volume, Structural Setups. Because human psychology never really changes, these specific structural formations just constantly repeat in the markets. Let's start with single candlestick reversals. Take the hammer. It's a small body with a long lower tail that forms at the bottom of a downtrend. That tail literally proves buyers violently rejected lower prices. But here's the catch. Context is everything. The hanging man has the exact same shape as the hammer, but it forms at the peak of an uptrend. That signals a heavy wave of new selling pressure is suddenly emerging. We also see shooting stars rejecting buyers at market tops and dojis, which look like super thin horizontal lines, basically screaming absolute indecision and a likely upcoming reversal. Now zooming out a bit, individual candles combined into classic structural patterns. The head and shoulders pattern is infamous for marking major market tops. When that right shoulder fails and breaks the neckline support, you better look out below. We also have M-shaped double tops and W-shaped double bottoms. But keep in mind, markets don't just reverse, they need to rest. That's exactly where continuation patterns like contracting triangles or bull flags step in. They act as quick little pit stops before the next big vertical move. But here is McAllen's absolute golden rule. Price without volume is a trap. Volume equals conviction. A breakout on massive volume, that is institutional capital actively driving the market. But a breakout on low volume, alarm bells should be ringing in your head. Big money is totally absent. That is a false trap set by market makers to lure in retail traders right before they pull the rug and push the stock back down. While clean price action is definitely best, we do need some tools to filter out the noise. The 50-day and 200-day moving averages are absolutely essential here. Think of the 200-day moving average as your ultimate macro benchmark. If the price is above it, the broad environment is structurally bullish. If price falls below it, the environment is bearish. It's that simple. These lines also act as dynamic, sloping support and resistance levels, giving you some truly incredible low-risk entry points during healthy trends. Section 5, Risk Management and Psychology. Protect your capital. This is crucial because spotting beautiful chart patterns means absolutely nothing if you don't fiercely protect your money. Before you place a single trade, you absolutely must remove your blind spots using top-down analysis. Do not fight the tide. Step 1. Use the weekly chart to figure out the massive macro trend. Step 2. Drop down to the daily chart to hunt for your patterns, your support levels, and volume. Step 3, zoom into the hourly chart to execute a laser-precise entry and set a tight stop loss. And speaking of stop losses, here are McAllen's unbending, non-negotiable rules for risk. You must operate like a disciplined business manager protecting your inventory. First, never risk more than 1% to 2% of your total account equity on any single trade setup. Always place a hard stop loss the moment you enter and make sure it's at a technical invalidation level. Meaning, if the price drops to this exact point, your chart hypothesis is officially proven wrong. And the absolute golden rule of risk? Never ever move a stop loss further away just to avoid taking a small, manageable loss. Let me tell you why those rules are basically a financial superpower. Technical analysis is simply a game of probabilities. If you maintain a strict 1-to-2 risk-to-reward ratio, say risking $200 to make $400, you only need to win 40% of your trades. Think about that. You can literally be completely wrong 60% of the time, take multiple small losses, and still build consistent wealth over time. You don't need to be psychic. You just need to do the math. The real reason 90% of retail investors fail isn't because of the math. It's the internal battle between fear and greed. Greed creates that terrible FOMO, convincing traders to buy euphoric tops right into massive resistance levels, while completely ignoring low volume. Fear, on the other hand, paralyzes them at the exact moment a low-risk support entry triggers. Or even worse, it forces them to panic sell the absolute bottom right before the market inevitably bounces. Ultimately, the only way to defeat fear and greed is to write out a concrete trading plan and systematically execute it without any emotion. So I want to leave you with this final thought based on Fred McAllen's powerful framework. Will you just continue to rely on Wall Street's illusions, holding and hoping while salespeople collect hefty fees off your hard-earned money? Or are you ready to ditch the emotional guesswork, draw your levels, manage your risk, and master the raw, undeniably true language of the market? The choice is entirely in your hands. Keep analyzing your charts, and we'll see you in the next explainer.